Forex, the range typically is capped by London close, and that's 10 o'clock in the morning to noon. In ES or stock index futures, the range can go beyond what Forex can do at London close. It can encapsulate the daily range for Forex, but stock index futures can go beyond that. So where euro dollar and pound dollar and other foreign currencies, they may be done for the day. They made their daily range. Stock index futures can go beyond London close, which is why we have a PM session. So it's the fact that we're forming the expected low based on that standard deviation, but the time it hits it, which is the the London close, that time meeting price, which is the standard deviation, when these two come together, then it's a complete picture. Then that's your daily range. You're done. When I was showing the new week opening gap chart, I was talking about how these imbalances on the fair value gap theory, but applied to the gap that's created from Friday's closing price and Sunday's new opening price, and the midpoint of that, which is consequent encroachment, how they act as magnets for fair value. The algorithm will sweep up to and down to old new week opening gaps, and you're placing a minimum of the week you're trading right now, last Friday's closing price and Sunday's opening price. They have to be there, and then 4 weeks going back. So there's 5 of them constantly on your chart. You're welcome to have as many as you can keep on your chart and not lose sight of the candlesticks. But I keep 5. The week I'm in right now, and looking back 4 more. So that's what's on my chart. Okay. The new day opening gap, I have that every single day. I have a template that shows every single new day opening gap. So in TradingView, you want to create those templates. And I talked about the new week opening gap since I mentioned it and just opened the discussion about it the last 2 weeks. There's a lot of attention around it, interest, and the new day opening gap and the consequent encroachment of those two respective imbalances. And now I taught the implied fair value gap. And yes, there's other things. And I thought about trying to release one new thing each week. And it kind of hit me earlier this afternoon. I think I might do two more concepts that are brand new, but what we have now with the core content, last year's model, and the introduction of the new week opening gap, new day opening gap, and the implied fair value gaps, we have enough weapons to make you a savage. We can do that. I didn't need to do what I've done in the last 2 weeks, just using what it's already on the YouTube channel. I can make you into a consistently disciplined speculator. When we look at these new week opening gaps, I spoke on the topic of how it goes back to constantly referring to them as a dynamic fair value. So the concept still is fair value. It's going back to these levels because it is utilized to inspire large fund sentiment, not retail stop me out. It's to inspire fair value for large institutional investors that bring money into the marketplace, because it comes back to these levels knowing that typically they use the analysis of the previous week. And if the market has moved away from those levels, the algorithm prices in, and it's coded to allow it to reprice back to those levels to offer opportunity for large flows to enter the marketplace. Not that large flows pushed price to these levels. It's going to go to those levels regardless of how much buying and selling is going on. But when it happens, it's designing the very stage for participants to come into the marketplace, have real orders right then and there. And then the counterparty dance between smart money and the less informed trader begins. The initial move at 9:30 is the fake move. That's the Judas swing. If 9:30 hasn't seen that fair value gap traded to yet, and we have a move going down after 9:30, this is what I was outlining and talking about, that's a Judas swing, because I want to see it run into that 60-minute fair value. I was looking for price to go up to the buy side and dig into that 60-minute fair value gap. That drop down on the 15-minute time frame is dropping down into a 15-minute fair value gap. And it's also dropping down into a 15-minute order block that's bullish inside of a bullish breaker that's on the 1-minute chart. So you have a bullish order block on the 15-minute time frame. You have a bullish breaker on the 1-minute chart. You have a 15-minute discount fair value gap that it comes down into perfect delivery to the low tick. But he's using me prompting him saying, okay, do you see that right here? All right, right when it does this, you want to see, and then what he's doing is he's contemplating and he's wrestling like, okay, do I do it right now? Do I wait? And I'm yelling at him. I'm like, what are you waiting for? And he's clicking the button, but it's late. So I'm scolding him. This is what you don't want to do. Now, because you bought it when it's an up candle, you've created an opening range between where you entered and where your stop loss needs to be. You're making larger risk for yourself. You don't want to do that. You buy in down close candles or candles that are going down. You can grow comfortable doing that. When it hits that low tick of that 15-minute fair value gap, I'm looking at that consequent encroachment where when the market doesn't do something that you would normally expect, if it doesn't do that, doesn't that imply weakness? Yes. At that moment, when it trades up into consequent encroachment, at that very moment, it looked just like a retail bull flag. Once it goes to a level that we expect that would limit the upside, how far the rally up can go. Well, there's your 60-minute fair value gap I outlined. I didn't say anything higher, did I? But then when it dug into it, the NASDAQ said, I ain't confirming this. I'm not co-signing this. You're on your own, ES. And it left it up there at the pinnacle of its daily high. But not before trading into that fair value gap I outlined this morning. So now we have ES at a premium high off of a Judas swing after 9:30. It met our objective, but more specifically, it couldn't even get to the upper end of it. It left the upper portion unfilled when NASDAQ had a divergence that it made a lower high. At the same time, if you look at the dollar index, dollar's bullish. So we have the perfect storm. S&P has gone to where I was expecting it to go to and outlined beforehand on the basis of how I expected it to deliver. At the same time, NASDAQ failed to go higher with it. That's a cracking correlation. That's what smart money sees as the green light go in there and start shorting S&P. While the dollar rages higher intraday, that's going to allow what? The sell program in ES and NASDAQ to accelerate to the downside at risk. And it's not a lot of money that he's going to make, hypothetically, right? So I'm teaching him to work with one contract. And the goal is for him to understand that he doesn't need all the movement that he saw today. You have to get comfortable embracing uncertainty. But when you learn what it is I'm teaching you, it's not uncertain. It's specific. It's highly precise. I'm saying, all right, I like this. It's running to sell side here, and this is where it's going to go. This is the objective. They're very specific terms. If I'm saying note this, I'm saying reference this on your chart because we may need this in a few minutes or later in the day. That's not the same thing as, oh, he's calling a fair value gap. When it gets there and it goes up to it, he's selling short there. That doesn't mean that. I might be referring to that level as it has to go through it and then come back down and find it as support. Much in the same way I mentioned this morning when we left that fair value gap that returned back up to it. So I'm teaching you that if you are thinking there should be a trade there, right now is where you have to dig your heels in and accept that uncertainty. It's 50-50 right here. We need to see it break, and it needs to go down through the candle that formed that fair value gap. And I wanted to see it go down below that. And I said, note that, extend it forward to the right across your chart. And we want to see it act as resistance. But they repeat, and there's no reason to get upset. They keep repeating. This stuff repeats every day. And you have to filter out all the bullshit or you'll fall victim to distraction. And you won't see when your model delivers in price. So you can act on it. And the market obviously, broke down aggressively today and just kept delivering more and more and more lower prices. That range from that high down to the 830 low, if you take your Fibonacci laid across that and project the Fibonacci standard deviations, which is why I had my Fibonacci settings up there. Because I said, some of you are probably just watching this video for the first time and you want to know what my settings are because they don't look like your typical settings. You're right, I don't use retail settings. I'm looking at standard deviations because that's what the algorithm is going to do. It's going to do measured standard deviations within specific ranges. And I'm teaching you what ranges to use based on the time of day when they're going to be referred to by the algorithm. Every day, why I'm talking to you, why I'm teaching it to you. But for now, this year only, keep the attention and focus on you. Focus on learning what it is I'm sharing, the things I'm talking about at that moment. Try not to do anything extra. Don't dilute your attention. It's too easy to be distracted with other things that can be learned at a later time that's already on my YouTube channel. So I understand when I'm teaching this, there are going to be people that come to me and say, this is bullshit. This is too complicated. This is too much. He's complicating everything. No, how do we know what the script is? That's what I'm teaching you this year. But before I can break down those lessons, I have to prove it exists. And that's what I've been doing, proving it. That's foresight. That's understanding. This is how you know what it's going to do beforehand. You've handled it before. You know how it's coded. You know how the source code is there, what it's going to refer to, why it's going to do certain things in reference on other points in the past to deliver something that you won't recognize real time, but it looks perfect and understandable in hindsight. And you're subscribing to and creating a cult like religion, which is what retail is. But all of them out there selling shit, they'll say, I'm a cult leader and you are all part of my cult. And we are a cult of winning. We're the cult of precision. We're the cult of knowing that we know what we're doing. Okay. So if that's a cult, I didn't see that in retail stuff. And I tried everything. And when you step out of that stuff and you look at price through the lens I'm showing you to view it through, they're all convinced that there's something different with this guy named ICT. And what's different is I got the truth. The skill, once you acquire it, I'm interested to see what you do with it. I can't wait to see what some of you do. Some of you have no idea how far you're going to go. And I'm excited to see it. Like, I'm here for that. I want to see that shit because some of you are absolute dynamos without even knowing it yet. You just need to know what to do, when to do it, and get out of your own way. And once that happens, magic unfolds. And I'm hoping I'm going to find that right person that has absolutely stone cold killer discipline, impeccable risk management skills, and learn how to do what I'm teaching to do in these markets precisely. Man, when you hear me outline these markets, when you watch me execute and manage these positions, you don't understand how much failure I had early on. You don't know the times that I went to sleep weeping, feeling like I'm never going to get this shit. You're in Fight Club. The first rule of Fight Club, we don't talk about Fight Club. You're going to get black eyes. Your friends and family are going to be, what's wrong with you? They're going to know something happened. You went through a rough period of learning. You just fell down the steps. You caught up volleyball to the eye, an elbow. You're playing ball with your boys, caught an elbow. There's going to be times when you go through this year with me, you're going to be worn out. It's going to feel like, man, that was a rough week. And I'm not sure what I learned. 2 months later, you're going to know what you learned that week, but you're going to be battered and bruised with the level of observation, journaling, studying, watching videos until you're fucking falling asleep while they're on. It's like college. You're cramming a PhD level education inside of less than a year. But the benefits far outweigh not having done it. And you can write your own check with this skill set. Whatever you want to do with this, once you know how to do it, and that's a big chasm between knowing how to do it and starting here and trying to do it. You're going to quit. You're going to do other shit or put it aside for a little while. And then later on, when the shit in your life is too much, you're going to be like, you know what? I'm going to go back to that and start again. I have students that make money right now that came to me as a paid student, left, quit, tried to do some other bullshit, lost there and said, you know what, I got to go back one more time, and came back with the mindset that was proper, understood that it was going to be hard. And now, if you listen to them, they'd be like this, the feeling of going into this, wanting it to be easy is what is the problem. You want it to be easy. And I don't care who you learn from, any kind of retail bullshit. As soon as you add money to it, it's hard. When you get out there working with a demo account properly, you're learning to follow rules. You're not learning how the market platform works with just a demo. No, no, no. You are learning how to read price action and then how you're going to look for a setup that you're going to go to as this is your model. This is what you're looking for. Each time you go into the marketplace looking for a trade, you're not rediscovering what it is you're going to do. You're looking for that very thing that you go into and you're going to do as a trade entry. What frames the risk on it? It will always be the same. That's why I told my son, that's why I teach you. You have to use a stop loss that's no larger than 5 handles. For some of you, it's like, what the hell? I can't do that. You can. You have to go in looking for it. That means you're going to have to be on lower time frames, and you can do very, very well with one contract. One contract is easy to manage. You're all trying to do these funded accounts. In a demo, you're trading like a wizard because you don't care about the outcome. You don't care. Well, there's the problem with why demo to live is a hardship, because you care about the profit coming and you care about the losing trade coming. You care. You have rushed into trading with live money. You are aware, you're conscious of the fact that you're in debt, that you don't make enough money, and you are conscious that you are impatiently driving very hard and fast to get more money in your hands because you think you're going to trade your way out of insignificance, mediocrity, and being broke. And as soon as you go into live trading, what you're bringing to it, because what I'm teaching works. If you just do this and stick to the rules, it works. Where it is a failure for traders that start with live funds too soon, you care about the outcome. You care about being right or wrong. You're afraid of being in too early, and you're afraid of getting in too late, which causes paralysis. So you're looking at the chart and you're watching, and you know it's going into that area. I should be doing it, but let me just watch a little bit more. All right, it's running now. All right, it's up eight. It's up 8 handles now. All right, if it just goes down one more, two more handles, then I'll buy it, because that means that I'm doing what ICT said. I got to buy when it's going down. Oh shit, it's not going up. No wonder stressful. No wonder it's stressful with live funds, because you're not doing what you were trained to do properly, because you didn't learn shit. You rushed through the lessons. You didn't do the things I told you to do. You haven't adopted discipline, and patience was not forged at all because you binged watched videos. You listen to these spaces like this and it might entertain you. That's the college professor ICT. Here, I'm the drill sergeant. You're not sleeping in, sleeper. Wake up. And I'm going to tell you all about yourself. And you need to know that. It's not me. It's not the concepts. It's not the market. It's you. And you have to figure out how to wrangle all these problems that you're bringing into it, which is the fear of being wrong, the necessity to make a lot of money, which that ain't, and it's not possible. You can't take ignorance and go into these marketplaces and consistently make wealth. It doesn't work that way, but that's what you're doing. What if you're not precise? What if you aren't really that good at getting in? What would be reasonable? That's what I was doing. I was doing close proximity entries. What differentiates from what I do? I know there's going to be a fair value gap that forms in the first 45 minutes of trading. I know I know that I'm going to get a volume imbalance in the first hour. I know that I'm going to have 4 trade setups guaranteed between 9:30 and 11 o'clock in the morning. No matter what profile, I'll have that. I know that I have 4 trade setups between 1:30 in the afternoon and 4 o'clock. I know every day, every market profile. I know they're there. They're there waiting for me. I'm not guessing. I can do that, and you're going to learn to do that. That's what the distinguishing factors about what it is that I do and what I teach my students. We're not wondering when our next signal is going to come. We know when and how it forms. That is a level of confidence that you cannot, once you have that, you sound like me. If you start talking about what it is that you do, you'll sound like me. To the neophyte, to someone that's just coming across me, and that's exactly how you want your trading to be. You want your analysis to be predictable. You don't need guess if there's going to be a fair value gap that sets up for a run into liquidity. That's the easiest thing. Like literally, think about this for a second. Think about it like this. If you have a clear, obvious level that has relative equal lows, or where the market went up into that fair value gap on the 60-minute chart, and that was our target. But then looking at the NASDAQ, it failed to make that higher high. And then the market went down below its short-term low in the S&P and the NASDAQ and created its imbalances. Don't you know, in every fiber of your being, don't you understand that that fair value gap right before it runs to a sell side or buy side liquidity, don't you understand that forms every day? The continuity of that price delivery is what I'm talking about. That's the part you don't understand. You have no idea what I'm referring to. And as many times I've said it, you have your fingers in your ear, you're plugging your mind up, like you don't want to listen to it. You've already convinced yourself that this is no way possible. And I'm taking it back to the argument. If it's not this, then how am I able to do it? And that's why I tell people, spend a year with me. You're going to see things that makes it undeniable. You'll also see the cycles that come through in the marketplace. You'll see the seasonal tendencies. All those factors will build on your understanding, and it'll help you fortify the confidence that you need. All you have to do, write this in your journal right now, okay? To quit your job, all you have to do is find something that repeats every day that can yield you 5 handles. Here's the easiest, most straightforward ICT lecture. Ready? Watch price in the morning between 9:30 and 11 o'clock. Wait for price to run through a liquidity above or below. Don't even have a bias. You don't care about a bias. I don't need a bias. I teach you because it's better for you to work within a higher time frame directional bias. It's easier to trust and see the setups because as a new student, there's just so many things to consider. What swing high do you use? Which dealing range do you use? You know, what order block? What's fair value gap? How do you know when it's going to? You can see how fast this compounds and inundates a new student. I understand the frustration, but there's no shortcutting the experience of watching it live, and then you'll find your own model. But if the brass tacks was laid down, here it is. This is it. If I was to go back in time and say, okay, I know nothing. I know nothing about optimal trade entry. I know nothing about the model 2022 that I gave you last year. All I would be looking for is I want to see an obvious run above a high or relative equal highs and then reject that. I want to see an opposing liquidity pool. I want to see it move sharply in that direction. Once it does that, any any of them, once that occurs, as soon as it trades into fair value gap, I'm using that. I'm putting a 5 handle stop loss on it, and I'm waiting for it to rip. 5 handles, half my trade's coming off, and then I'm waiting for it to trade into the opposing liquidity. There it is. And then that's not me saying you're quitting your job in 90 days. I'm just saying I know that that repeats. Knowing what I know right now, if I can go back in time and tell myself this is the thing that's going to repeat every fucking day, it's literally no effort. It's no effort, none, zero effort required to do that. And I have students that trade models very simplistic, just like that. You can make a model very, very complex, but I can also make a very, very simple elementary approach to it, like I just gave you here and what I presented in detail in 2022's mentorship on my YouTube channel. I can make it very, very simple, but even when it's most simplest delivered, if you don't know the experience behind its development, how often it forms, how you engage it, what is it you're looking for. Just because I say put a stop loss on the trade for 5 handles, do you know what that means? Where are you going to place your stop? Because you have to know where you're getting in at. Where are you entering? What's your multiplier? What's the PD array that you're using for the setup every single time you take the trade? If you're going to use the fair value gap, you're going to put your stop, if it's short, you're going to put your stop loss above the candle that makes the fair value gap. If you can't do that with 5 handles, can you take the trade? Well, that depends. If you can trade it with a micro, you can take the trade. But if it's more than 5 handles, even with the problem that you realize once you know how to trade is that you were told you can't make money with 1-to-1 when you can. That's what high frequency algorithms are doing all day long. Some of them are doing less than 1-to-1. They have a negative. They're trying to make less than what they're risking because their frequency of entry is so high paced. And the thing that they're utilizing for a catalyst that gets them in the trade and get right back out of it, it repeats so often, it doesn't care. The creators, the coders that utilized it and implemented that logic, they don't care about the 35 or 40% losing. They don't care because they have that statistical edge of 60% of that high frequency order flow in their favor is going to compensate over time, even on a day by day basis. What happens more frequently? A 30 handle run intraday, one way, or 6 5 handle trades, multi directional. I don't care how big the daily range is. 6 5 handle trades is going to happen more frequently than a one pull single run of 30 handles in the same day because there's more fluctuations in price than there are sustained 30 handle runs in one direction. One directional runs, 30 handles, there isn't a lot of them within the same day. But there is multiple deliveries of 5 handles up, 5 handles down, 5 handles up, 5 handles down. All of that intraday volatility is what high frequency trading algorithms capitalize on. Here's what you're being lied to and being told, that the algorithms are causing that to happen, and they're not. They're engaging in that delivery of price, and the disparity between where price was 5 minutes ago and where it is today, or next 5 minutes. That is what it's capitalizing on. So how many intervals of 5 minutes occur over the span of a trading session? A lot. And these high frequency algorithms are constantly plowing through that, harvesting all of these minor fluctuations. And you're out here trying to get 20 pips a day, 50 pips a day, 280 pips in an hour. it's it's not needed. Price is going to be offered continuously higher up. If the algorithm is going to be doing a repricing to a, say, an old high, an intraday high, and it's already done its run for the day on the downside, so now it's going to just reprice, keep going higher, 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 higher. You have seen these days before. When I was first starting out, I lost a lot of money fading that. Every time, okay, there's no way it's going to keep going up. It's been going up constantly, slowly, all day long, tick after tick after tick, no retracements. It just keeps going higher, higher, higher. What's going on there? The market's just perfectly balanced with buyers, and they don't want to ever see it retrace ever. It just constantly just makes a small little incremental move higher, higher, higher. That's an algorithm. That's what's going on. And look at the depth of market and the level 2 data when those days occur. It looks like any other day. Your perception about price and how these markets book will instantly change. And the things that you're fearful of and concerned over, oh, the market's going to do this or the market's going to do that. No, they're not, until there's manual intervention. When somebody says, okay, unexpected rate announcement, a surprise rate cut, or a surprise rate hike, a war event breaks out, a pandemic begins, something that was unexpected, which is referred to many times as a black swan. A black swan event is an event that no one knew when it was exactly going to happen, and it's a surprise and shock to most people, and it's going to send shockwaves through the marketplace. That's a manual intervention. A manual intervention is when the euro and Swissy was depegged, and it wrecked people and brokerage firms, literally instantly wiped out, insolvent. That's manual intervention. That's the risk that you and I incur every single time we speculate in any market. Anytime there could be a massive upheaval in these financial instruments that is either organic or synthetically engineered. Either one can wreck you. Either one is unpredictable. And that risk is the only risk that I really fear. I don't fear doing a trade, getting it wrong, and losing money, because I know what I look for repeats. So I don't want to be in Forex right now because I'm expecting a black swan event like a Euro and Swissy depegging. When that, but Euro and Swissy being depegged, that was nightmarish. Like it was, you can't survive that. And we're in a climate right now where they're ringing in this year central bank digital currency.